Two investors, same strategy, same product, same investment amount. One lost 60%. The other turned 100,000 into 700,000. The only difference was that they started just a couple of years apart. That is luck. And it is one of the biggest secrets in investing that most experts never talk about. In this video, I will show you how luck can quietly shape your results even if you do everything right. And most importantly, I will show you two strategies that can protect you from bad luck and dramatically improve your investment returns. First, let me tell you a tale of two investors. Let's call the first one investor unlucky. He starts investing in 2007, right before the global financial crisis. He puts 100,000 into the market. Then everything falls apart. Banks collapse, panic spreads. People are afraid that the entire financial system could crumble before their eyes. His portfolio drops 60%. And he says to himself, "Why did I ever start investing?" So he sells, locks in the loss, puts money in the bank. Now, let's meet investor lucky. He starts investing in 2009, just 2 years later. The market has already crashed around 60%. People are terrified, but investor lucky invests. Now, of course, very few people actually did that because nobody wanted to buy stocks back then. But for the sake of simplicity, let's ignore that for a moment. Now, over the next 5 years, the market goes up 100%, and his 100,000 grows to 200,000. He feels like a superstar. And because he feels confident, he keeps investing. Now, today, investor unlucky is sitting in cash. His original 100,000 is now worth around 90,000, even with bank interest included. Meanwhile, investor lucky's portfolio has grown to 700,000. Same market, same product, same strategy, same long-term mindset. Completely different results. Because one started at one of the worst possible times in recent history, and the other started at one of the best. And this is the surprising role of luck in investing. Now, if you find this kind of investing content valuable, click subscribe so you don't miss my new videos. I publish simple, practical investing lessons like this every single week. But here is the thing most people miss. You cannot eliminate luck. But you can do two things that completely change how luck affects your results. And the second one is something that most investors are too afraid to do. But first, let me show you why luck is even more powerful than you think. Most people want investing to be a clean story. This investor succeeded because he was a genius, and that investor failed because he was stupid. But real life is not that simple. Nobel Prize winning psychologist Daniel Kahneman said it perfectly. Success equals talent plus luck. And great success equals a little more talent and a lot of luck. Let that sink in. Great success is not just about being smart. It is also about luck. And in investing, luck plays a bigger role than most people want to admit. Now, of course, skill matters a lot. If you don't understand the basics, if you buy expensive funds, if you follow hot tips from neighbors, or if you treat your portfolio like a casino, you can lose a lot of money. Skill helps you avoid big mistakes in investing. But skill does not control everything. Skill is like preparing a perfect gourmet meal. Luck is the delivery guy actually finding your house. And here is where many investors get into trouble. They look at lucky people and assume they are brilliant. Someone buys one stock and it goes up 300%. Suddenly he thinks he's Warren Buffett, minus the wrinkles. And then someone buys the right crypto coin at the right time. And suddenly he has a sixth sense for crypto. A fund manager has one great year. And suddenly everyone calls him a genius. But was it skill or was it luck? When people confuse luck with skill, they become overconfident. They start taking bigger risks. They stop following a plan. And sooner or later, the market reminds them who is really in charge, usually with a baseball bat. Now, Daniel Kahneman call this illusion of skill. We see one great result and we assume it must be talent. But in investing, short-term results can be heavily influenced by timing and luck. A crypto influencer is right once. This doesn't mean he's brilliant. A trader makes money for 6 months. This doesn't mean he discovered the secret of the universe. A fund manager beats the market for 1 year. That doesn't mean you should give him your pension. In fact, over long periods of time, most active fund managers underperform the market. Even the best investors in the world cannot consistently predict short-term market moves. Not Warren Buffett, not Ray Dalio, not me, and not the guy on YouTube who says massive crash coming every single week and then takes credit when it finally happens after 7 years. So, should you give up? Should you say, well, if luck matters, then investing is just gambling? No, that's not the way it works. That is the wrong lesson. The right lesson is this. You cannot eliminate bad luck, but you can reduce its power. And you can increase your chances of being lucky and of getting great returns. The first way to reduce the power of luck is to invest regularly. Instead of trying to invest everything at the perfect moment, you invest again and again over time, month after month, quarter after quarter, year after year. This is called dollar cost averaging. I know it sounds like a boring finance textbook term, but the idea is very simple. You don't bet everything on one moment. You spread your entry points over time. Now, sometimes you buy when the markets are high. Sometimes you buy when the markets are low. Sometimes you buy when the markets are calm, and sometimes you buy when the world looks like it is on fire. Now remember investor unlucky. He invested 100,000 all at once in 2007. Terrible timing. But what if instead of investing everything in one moment, he invested 5,000 per month? His first investment would still have been at the worst time, but his fifth investment would have been at lower prices. His 10th investment even lower. By 2009, he would have been buying near the bottom while everyone else was selling in panic. Now, suddenly, his story changes completely. Yes, first investments were terrible timing, but his later investments had much better timing. By investing regularly, he gave himself more chances to be lucky. And that is very important. If you invest only once, your results depend heavily on timing and luck. But if you invest regularly, one bad moment does not destroy your whole plan. You are not trying to hit the perfect shot. You are giving yourselves many shots. And this is how you reduce the power of bad luck. But there is a second strategy, and this one is emotionally much harder. Most investors can do it, but the ones who can often see the biggest gains. So, now let's talk about the second way to increase your chances of being lucky. And this one requires something most investors don't have: courage. When markets are going up, everyone wants to invest. People feel safe, they feel confident, they think the good times will last forever. But when markets crash or there is a correction, everything changes. The same people who wanted to invest at high prices suddenly become afraid to invest at much lower prices. The headlines scream crash, recession, disaster, and people freeze, or worse, they sell. But the best long-term opportunities appear when everyone else is scared. This is what I call the reverse psychology of investing. When everyone is terrified and selling, that is usually the best time to buy. When everyone is euphoric and buying, that is usually the time to be cautious. And this is not just theory. My members and I have been doing this consistently since 2012 when I started. Let me give you a couple of examples. In November 2022, Bitcoin crashed 77%. The biggest TV host in America told millions of people to sell. One day later, I told my members to buy, and we made 400 to 600% returns. In April 2025, Trump announced tariffs. This was the Trump chaos. Markets dropped 25%. Everyone screamed recession. I sent my 8,000 members a video called Trump Chaos, I'm buying. And that was on the day of the exact bottom. And I could go on and on and on. Now, was there risk? Of course, there is always risk. But when you combine regular investing, a long-term plan, and the courage to act when others are panicking, you don't remove luck. But you reduce the chance that bad luck destroys you. And you increase the chance that good luck finds you. Now, if someone you know is afraid to invest because they think their timing may be bad, share this video with them. It could completely change how they think about luck and timing. So click pause and share this video. Smart investing is not about predicting every market move, guessing the next crash, or finding the perfect day to invest. It is about building a system where you don't need everything to be perfect. Most investors don't lose because they get unlucky once. They lose because they make bad decisions when luck goes against them. They panic, they sell, they stop investing, they wait for the perfect moment, and while they wait, market recovers without them. That is why staying in the game is so important. You don't need to predict every storm. You need a ship strong enough to survive the storm. And when the sun comes back, you are still there and you are winning. Now let's go back to Kahneman's quote. Success equals talent plus luck, and great success equals a little more talent and a lot of luck. In investing, you need both. Skill helps you avoid expensive mistakes, high-fee products, underperforming funds, and everything that promises fast riches with no risk. But luck is still there. Sometimes luck is the year you start investing. Sometimes it is the crash that creates a buying opportunity. Sometimes it is simply staying invested long enough for the market to reward you. So the real question is not how do I remove luck from investing, because you can't. The better question is how do I build a strategy that can survive bad luck and benefit from good luck? And the answer is simple. Invest regularly. Think long term. Keep costs low. Avoid crazy products. And when markets crash, don't run away in fear. Look for opportunity. You cannot control the market. You cannot control headlines. You cannot control when the next crisis hits. But you can control your habits, your mindset, and your strategy. And that is how you turn luck from your enemy into your partner. Now, if this video helped you see investing differently, click the like button and subscribe to the channel. Studies show that my subscribers are luckier in life, smile more often, and somehow become better looking immediately after subscribing. And if you want my complete system for building long-term wealth in a simple way, I invite you to join my 90-minute masterclass. It's free to attend. I will show you how to invest without wasting your life watching charts, following market predictions, or listening to Wall Street experts who sound smart but often get it wrong. You will learn how to build a smart long-term plan, how to avoid the most common mistakes, and how to make your money work harder for you. The link is in the description. And remember, you don't need perfect luck to become a successful investor, but you need a strategy that gives luck more chances to help you. See you in the next video.